Reading stock charts like a professional has very little to do with predicting the future, and almost everything to do with understanding behavior. Charts are not crystal balls. They are visual records of collective decision-making under uncertainty. Every candle, every trend, every consolidation represents fear, greed, hesitation, conviction, and regret expressed through price. Professionals do not read charts to feel smart. They read charts to reduce surprise and control risk. That distinction is where most beginners go wrong. The first misconception to clear is that charts exist to tell you where price will go. In reality, charts tell you where price has been accepted or rejected by the market. They show where buyers were strong, where sellers overwhelmed demand, and where uncertainty dominated. A chart is a map of prior battles, not a prophecy of the next one. Professionals read this map to understand context, not to chase certainty. The most important skill in chart reading is identifying structure. Structure answers the question: is price making higher highs and higher lows, lower highs and lower lows, or moving sideways? This alone filters out a large percentage of bad decisions. In an uptrend, pullbacks are potential opportunities. In a downtrend, rallies are suspect. In a range, patience is required. Many traders fail not because they misread indicators, but because they ignore structure entirely and trade against it. Time frame alignment is the next critical layer. Professionals never look at a single time frame in isolation. A setup that looks attractive on a 5-minute chart may be meaningless or dangerous if it conflicts with the daily or weekly trend. Higher time frames carry more weight because they reflect decisions made by larger, slower-moving capital. Lower time frames are execution tools, not sources of truth. Reading charts like a pro means knowing which time frame answers which question. Support and resistance are often taught poorly reduced to drawing random lines until something appears to work. In reality, support and resistance represent areas of memory. These are zones where price previously stalled, reversed, or accelerated. They matter because traders remember them consciously or not. When price returns to these zones, behavior changes. Professionals think in zones, not exact lines, and they ask what price does when it reaches them, rather than assuming an automatic reaction. Candlesticks themselves are expressions of auction dynamics. A long wick shows rejection. A strong close near the high or low shows conviction. Small bodies clustered together show indecision. No single candle is magical. Context gives candles meaning. A bullish candle at resistance after an extended run means something very different from the same candle after a deep pullback into support. Professionals read candles as sentences, not as isolated words. Volume adds another dimension. Volume answers the question, how much effort did it take to move price? Breakouts on expanding volume suggest participation and commitment. Moves on declining volume suggest exhaustion or lack of interest. Volume does not need to be interpreted precisely. It needs to be interpreted relatively. Professionals look for confirmation or divergence between price movement and participation, not exact volume numbers. Indicators are where many traders get lost. Professionals use indicators sparingly, not because indicators are useless, but because they lag price and can distract from structure. Indicators work best as confirmation tools, not decision makers. A moving average can help define trend. Momentum indicators can highlight overextension. Oscillators can signal compression. None of them should override what price itself is doing. When indicators conflict with price, professionals trust price. Another crucial aspect of chart reading is understanding volatility. A chart that moves smoothly behaves differently from one that whips violently. Position size, stop placement, and expectations must adjust accordingly. Professionals read volatility to decide how much risk to take, not whether to take a trade. Many losses come not from bad analysis, but from applying the right idea with the wrong size in the wrong volatility regime. Perhaps the most overlooked skill is recognizing when not to trade. Flat overlapping candles, choppy ranges, and conflicting timeframes signal uncertainty. Professionals respect these conditions. They understand that waiting is a position. Charts do not owe you opportunities on demand. Forcing trades in unclear conditions is a sign of impatience, not skill. Reading charts like a pro also means separating analysis from execution. Analysis happens calmly away from live price movement. Execution happens according to plan. Mixing the two invites emotional interference. Professionals mark level scenarios and invalidation points in advance. When price reaches them, decisions are simpler. Charts are used to plan, not to improvise under pressure. Finally, professional chart reading is probabilistic. No pattern works all the time. No setup guarantees outcome. The goal is not to be right often, but to structure trades so that when wrong losses are small and when right gains are meaningful. Charts help define that asymmetry. They do not remove uncertainty, they organize it. As traders move from beginner to professional, charts stop being sources of excitement and start becoming tools of restraint. They answer fewer questions about what will happen and more questions about what is acceptable risk here. That shift in mindset is what separates those who last from those who burn out. And once this foundation is clear, the next step is learning how professionals simplify charts rather than complicate them, how they build repeatable chart reading routines, and how they avoid the most common traps that make charts look useful in hindsight, but dangerous in real time, which is exactly where we need to go next, by examining how professionals turn chart reading into a repeatable routine rather than an emotional guessing game. Because mastery comes from simplification, not accumulation. The first professional habit is stripping charts down to essentials. Most experienced traders eventually remove more indicators than they add. Price volume and a small number of well-understood tools are enough. Clean charts reduce cognitive load and make it harder to rationalize bad trades. When a chart looks confusing, that confusion is information. It usually means conditions are not favorable. A second habit is top-down scanning. Professionals begin with higher timeframes to establish context, then work downward only if conditions align. Weekly charts define the broad environment. Daily charts define actionable structure. Intraday charts are used for precision, not bias. This routine prevents the common mistake of falling in love with a low timeframe pattern that contradicts higher timeframe reality. Alignment does not guarantee success, but misalignment almost guarantees trouble. Professionals also predefine scenarios and invalidation points. Instead of asking, "What should I do now?" they ask, "If price does X, I will do Y. If it does Z, I will stand aside." This transforms charts from reactive triggers into planning tools. Invalidation points are especially important. Knowing exactly where your idea is wrong prevents small losses from turning into emotional battles. Charts are valuable precisely because they allow risk to be defined visually and objectively. Another key discipline is pattern selection, not pattern hunting. Professionals trade a small set of patterns they understand deeply. Breakouts, pullbacks range, rotations, trend continuations. They ignore everything else. Beginners often do the opposite, searching endlessly for new patterns instead of mastering a few. Familiarity builds intuition. Intuition built on repetition is very different from intuition built on hope. Journaling completes the learning loop. Professionals capture charts before entry, during management, and after exit. They note context, emotions, execution quality, and outcome. Over time, patterns emerge not just in markets, but in behavior. This feedback is where chart reading skill compounds. Without review, charts remain entertainment. With review, they become education. Finally, professionals accept that charts will never remove uncertainty. They are filters, not guarantees. The edge comes not from predicting outcomes, but from combining chart structure with disciplined risk management and patience. When charts say nothing, professionals do nothing. When charts say something clear, they act decisively but without attachment. In the end, reading stock charts like a pro is not about seeing more than others. It is about seeing less more clearly. Charts become quieter, decisions become calmer, losses become manageable. That is the real progression. Charts do not make you successful. They help you behave in ways that allow success to emerge over time. If this helped you rethink how you use charts, consider subscribing to stay with these long-form discussions focused on discipline over decoration, and leave a comment sharing which chart habit you plan to simplify first, because progress in trading often begins with removing what no longer serves you.